we were discussing how the bond and capital markets would have responded to the budget. No major responses there. Everybody just quite consistent, and we're not going to see major shifts in bond deals at the moment. That speaks to then what policy ought to be and the approach of the minister as described in the current budget speech. We were talking about the ratios of debt to GDP and using Paul's terminology, we're not a Mickey Mouse economy. These are still manageable debt levels for South Africa.
I would have to agree, and I think given that we are an emerging economy that needs to grow, we have an unemployment crisis to solve. I would have to say yes, I think our debt levels are still very much within manageable levels. As was mentioned, Japan is now at 200% of GDP, and their international risk rating is still far better than South Africa's. So it begs the question, what really goes into when you rate a nation? I think that our Minister of Finance, coming out of the SARS environment where revenue collection and good systems was critical, he is carrying on that legacy into the management of the national budget, and I think I have every confidence in his stewardship going forward.
Carl, your views on this one? Revenue at about 824 billion, expenditure 979. There's a shortfall here by way of collection of 18 billion. So how else to make the money?
Well, there are very few other ways to make the money but to collect taxes. I think we're in a fortunate situation where we are approximately 23 billion rand ahead on tax revenues from what it was estimated at last year. So I think that's good news. But other than that, the only ways to collect revenues are through taxes.
Your views on this expenditure revenue situation?
Well, look, I don't think he's got much choice. As I said previously, there's huge demand on the expenditure side, so he has to meet some of that demand, and there will be increasing demands. We can talk about the national health insurance, but there's going to be a lot of demands on expenditure, and obviously quite constrained in terms of taxes. What we've seen more and more over the years is that he's having to rely on what we call indirect taxes or excise duties on the fuel levy. Those form now a major part of tax collection. And obviously he has increased those further, so they're going to make up a bigger portion. And then hinting maybe at a VAT increase at some point. We haven't increased VAT for a long time. So it's telling you that he's running out of options in terms of where does he get the money from. There's not much he can do other than to keep plugging away at the usual suspects, and the usual suspects are right now excise duty and the fuel levy. I don't think he wants to change corporate taxes. I don't think he really wants to change much with the thresholds on individual taxes. He did provide some tax relief for individuals, but he is fairly constrained here. So for the last couple of years, we haven't seen radical tax changes. All the emphasis has been on expenditure and how to prioritize expenditure.
I mean, there's been some expectation that although tax relief in the last budget was moderate, and particularly for lower waged earners, that there needed to be a little bit more give for the higher income earners.
I think there's a massive issue here which nobody's talking about when you talk about revenue, and that is a privatization campaign. I mean, it's like barking in the backyard. Nobody pays any difference. But you know, countries around the world are all sitting with big shortfalls, and the thing which never gets talked enough about, in my opinion, is the state actually disposing of non-core assets. Massive state land ownership. What about the parastatals? We know that we've got a terrible legacy in this country which comes from DF Milan and HR Verwoerd and so on, that when you want to do some sort of thing economically, you must create a parastatal. That's really old style thinking. I think perhaps a bigger debate, which won't be positively received by the trade unions, of course, about disposal, for example, of some of these parastatals for a net gain for the state. We deal with our fiscal deficit in one fell swoop.
Your views on privatization, I mean, this has been one of those pink elephants in the room since post-apartheid.
Yeah, I think the experience with privatization, at least in some of our African countries, is that it can be a fairly painful process. Post-privatization, yes, you can unlock efficiencies, you can have better productivity and so on. But also what tends to happen is it can contribute to the unemployment problem that you're trying to solve. And we've seen this in a number of our countries on the continent. So if we are going to go that route, we've got to be mindful that unemployment is already at 25%.
You know, there's no point talking about something that isn't actually on the agenda of the ruling party anyway. What we do know is that the new growth path identifies state-owned enterprises as the engines to drive strategic objectives for jobs within manufacturing, within infrastructure, etc. So they're here with us to stay, Paul, whether whether you like it or not. The question is, what can they do to make them run better? And did we get an indication in this budget?
No, I don't think we got any indication that we're going to see a significant improvement in efficiencies per se. I think government is aware of that, and they need to deliver at every departmental level. So not just the public corporations or state-owned enterprises. I think that's an awareness across the board. And we are seeing incremental improvements. If we look at the rural development, if we look at elements of healthcare, etc., we are seeing some improvements there. But it's a big job ahead for government. I think
but at least we've got the sexy new government minister, Malusi Gigaba, who's going to change everything. Huh?
More money for SOEs?
It seems to be. I mean, when I look at this budget, I mean, there's more money for just about everything. And I think if I have a criticism at this stage, he really is trying to do a little bit for everybody. And as you go through it, it's allocations and improved allocations to just about every facet of the economy. And that perhaps just takes away a little bit from some of the key focal areas.
Okay, Stephen Gunyon, back to you at Parliament.
Thanks very much, Lerato. I'm joined now by Conrad Ross. He's the MD for Sub-Saharan Africa at Standard & Poor's. Conrad, we have that debt to GDP ratio set to rise to 40%, 1.3 trillion rand. We also have the current account deficit not quite as good as expected this year. Does that give you sleepless nights at ratings agencies?
It doesn't necessarily give me a sleepless night, but I have to say, I mean, from a ratings perspective, it was a kind of a neutral budget, but at the same time, it was presented with great confidence, but yet I would say it was also a sobering budget. It's clear deficits are here to stay now. It will be a challenge for the Treasury to bring the debt burden down further. And from here on, I think there is a lot less room for maneuver in the budget.
The debt burden, though, does look quite favourable if you compare it to debt burdens of similar countries, though, doesn't it?
Yes, it does, but in some way, there's always the risk of comparing apples and oranges. We have structural challenges here in the labour market. This is still a country with a large portion of the population that is in a low income bracket, and I think it's like with someone who's taken out a mortgage. Someone can afford more and someone else can afford less. And here, this is an economy we cannot accept, or we cannot say easily that a debt burden that is somewhere between 40 or 60%, depending whether you include the parastatals or not, and with the deficit where it is, that we are all clear and this is sustainable forever.
How do you think we're tackling these structural issues such as unemployment? That's been a key focus of the State of the Nation address 2 weeks ago and also of the budget today.
I mean, it is the right focus, quite obviously. We only have to look to North Africa and see how a young, highly educated population without jobs is coming onto the streets and toppling governments. So yes, I think this is the key issue for South Africa, job creation, to deal with unemployment. The problem there is no quick fix, and there is no silver bullet to solve all the problems. It will require money, as we are seeing now in the budget. It requires that the private sector contributes, that government contributes, and yet, and that is the delicate issue here, is it's not going to produce quick results.
How do you see the cohesion now of government policies? We have the Industrial Policy Action Plan, we have the New Growth Path, we had the budget today. Do you see government policies starting to tie together?
Perhaps slowly, but again now with the budget, for instance, the devil is in the detail. One really needs to look at this budget with a lot of scrutiny of the detail. One will have to see how the monies are being allocated and in the end how the policies are in effect executed.
Balance between macroeconomic prudency and the spending that we need for social welfare?
I think at the moment the emphasis for me clearly is on spending. The emphasis is on dealing with the issues of social pressures, job creation. Again, in the budget today, there was not that much reference to the SARP, to inflation targeting, to the macro side. I hope we can take it for granted that we will continue to see a certain conservatism in South African economic policies that will continue to enshrine macro stability the way we've used to see it now.
Conrad, thanks very much for your time.
Pleasure.
That's Conrad Royce, he's the MD for Sub-Saharan Africa at Standard & Poor's. Back to you, Lerato.
Thanks so much to you, Stephen.